the war is stability enough that is devoted to the presentation of the recent issue of our regular banking sector monitor. This event and the report we have written together is a cooperation between the German economic team, whose deputy team leader I am, the Institute for Economic Research and Policy Consulting in Kiev, and the Center for Economic Strategy in Kiev. I'm very glad that we can continue today the excellent cooperation with both of our partner institutions, which dates back in some cases for more than 20 years already. Our first banking sector monitor for Ukraine was initially published in 2017 and was meant to analyze the situation in the banking sector, describe trends and developments, and give an assessment of the wide-ranging banking sector reforms the National Bank of Ukraine had undertaken. This new report was very well received, and we decided to turn it into a regular publication where we discussed each new issue with a high-ranking panel with Ukrainian and international policymakers, analysts, and experts. The presentation of last year's edition of the Banking Sector Monitor was originally scheduled for the 24th of February of 2022, a day that I think all of us, but our Ukrainian friends in particular, will remember for the rest of our lives. In these moments of shock and horror caused by the Russian invasion, we obviously didn't go ahead with the event as scheduled. Still, rather than canceling the event outright, we sent during this very morning an email to all of our guests that informed them about the postponement of the event to a future date, not an outright cancellation. And about 2 months later, on 28th of April 2022, we did conduct the event under the title Banking Sector in Ukraine, The Keys to Resilience in Wartime, where we focused on the reasons for the sector's resilience, which can also be taken as a wider symbol for the resilience of the country as a whole. In today's presentation and panel discussion, we will move beyond stability and resilience and address also the question what the sector could contribute to Ukraine's recovery and reconstruction, and what is needed for that. Against this background, I'm delighted that we have managed to assemble such an outstanding panel of experts today. I'm very much looking forward to the discussion that will follow the presentation of the report. Having said that, I will now give the word to my colleague Gary Polushkin, the project manager of the German economic team, for his presentation of the Banking Sector Monitor. Gary, the floor is yours. Thank you.
Thank you very much. Can you see the screen? Great. Firstly, I'm gonna say a few words about past reforms in the sector. Then I'm gonna discuss challenges for the sector, which are dependent on the situation. Thirdly, two main aspects of the resilience are going to be discussed. And finally, I'm gonna argue that more measures are needed to prepare the sector for its role for Ukraine's reconstruction. Since 2015, Ukraine's banking sector and the National Bank has been on an essential reform path originating from the time under Governor Gontaryova. These reforms include improved transparency, collective decision-making at the National Bank. Also, the introduction and extension of comprehensive asset quality reviews, resilience assessment, and stress tests. The increase of required capital adequacy ratio and liquidity coverage ratio and further requirements were increased. The capital adequacy ratio went up to 21% in November 2021. That is even higher than in Poland or Hungary. And when and if these requirements were not met, then banks were liquidated or nationalized in case of systemic important private banks. As a result, the number of banks halved between 2015 and 2022. So let me conclude the first part with again emphasizing that Ukraine's banking sector has been well prepared by very important reforms by the National Bank for the worst situation by crucial institutional, macroprudential, and microprudential reforms. And now Russia's full-scale war has dramatic consequences for the economic situation of Ukraine and also for the banking sector. The economy fell by 29% last year and is forecast to increase by just 4 to 5% this year. Against this background, it is again very important to highlight that no bank runs occurred. This is a very remarkable development. Deposits remained stable and started to recover even in real terms. This development reveals trust to the sector on the one hand. On the other hand, is also a result of depressed private consumption and the development that savings, that military personnel were paid on saving accounts rather than spend these savings accounts. And this crisis situation is also highlighted by increased non-performing loans. They were already quite large, but on a declining path before the full-scale war. And now the development even worsened. However, some relaxation of NPL regulation during the first month of the war may have led to hidden NPL risks. So the reintroduction of postponed asset quality reviews, stress tests, and resilience assessments will be vital to discover the hidden risks. While deposits remain stable, lending has strongly fallen. And this development has been even worse, or would have been even worse, without the state subsidy program 579 that accounted for around 1/3 of corporate lending in domestic currency. On the demand side, corporates restrained from borrowing due to large uncertainty. And on the supply side, banks charge high risk premia. While a large liquidity coverage ratio reveals a strong resilience buffer, it is also a signal that banks prefer low-risk assets rather than lending. And though the National Bank introduced different measures to tackle this issue, still this preference remains. Therefore, policy to reduce risks of lending for both sides are to be recommended. For example, improving recognition of collaterals. And now let me come to the assessment of the resilience. The first and the main aspect that supports the current resilience is extraordinary policy response by the National Bank. Supervision measures have been decisive throughout the whole crisis. The upper chart displays the sub-index of financial stress in the banking sector. At the beginning of the full-scale war, the sub-index increased to a level higher than during the start of the war in 2014 or higher than during COVID. And let me describe the policy responses in 3 steps. Firstly, emergency responses, when the NBU ensured that banks had access to liquidity, review measures were postponed, and monetary policy regime revoked to a fixed exchange rate regime with postponed key policy rate decisions. Secondly, as the stress level calmed down, a certain adjustment period took place. The fixed exchange rate regime was adjusted and key policy rate decisions were resumed. But this was also the time when Russia started attacking Ukraine's energy infrastructure. So banks had to work with electricity blackouts and simplified access to cash to avoid bank runs. And now the third episode, recovery. Capital controls are now step-by-step liberalized. Key policy rate easing cycle started and is now accelerated by the recent cut to 16%. and also the resilience assessment started. All in all, the NBU's measures have been decisive during these extraordinary times to ensure stability of the sector. Another very important aspect is the digitalization of the sector. And let me show two indicators that strengthen this view. Firstly, contactless card and NFC payments increased fourfold between 2019 and 2022. Secondly, banks offering Apple payments has exceeded banks in Poland and Hungary and also increased in the numbers. This digital communication is a very essential part to ensure trust for the real economy, but also for households in the sector. For households both that are in Ukraine, but also that had to move. And let me now finish my presentation with the last slide where I put all mentioned aspects together. Worldwide, banks usually play an important role in financing investment for recovery, but this is not yet the case in Ukraine, as new lending is driven by state subsidy programs, for example, 579. Banks prefer low-risk assets rather than lending, and there is a lack of international funding to support the sector during the war. In this context, the National Bank published its financial sector development strategy, for example, including updated regulation, improvement of corporate governance, and adjustment to EU standards. However, these steps are just precondition for further or any market-based privatization. And further measures are needed. For example, enlarging participation in investment guarantee or export credit schemes, and thereby reducing risk premium and making loans more affordable. Let me conclude the presentation with again highlighting the extraordinary resilience of the banking sector in extraordinary times, supported by very essential reforms and policy responses by the National Bank. However, further measures are needed to prepare the sector for its crucial role in Ukraine's reconstruction. Thank you.
Thank you very much, Gary, for your presentation of this report. And just that you know, this report is also available for download on our website. So I encourage everyone of you to have a look at it and also to get back with us with questions you may have. Turning now to the panel discussion with our distinguished experts, I would like to introduce the moderator of the discussion, Maria Repko, the Executive Deputy Director of the Center for Economic Strategy, who will moderate that discussion. She's very well qualified because she's also one of the authors of this report, so she knows very much what she's talking about. So Maria, please take over. The floor is yours. Thank you.
Thank you very much, Robert, for this kind introduction, and I won't probably be long, and we'll start with presenting our esteemed speakers today. Today in our panel we will have Katerina Ryzhkova. She's the Deputy Governor of the National Bank of Ukraine and a person who is, among others, directly responsible for keeping the Ukrainian banking system afloat in times of war. We also have, we're really honored to have Artur Pogosyan, who is a Deputy Head of Ukraine Financial Institutions at the European Bank for Reconstruction and Development. And we know that the size of the financial help of the EBRD to Ukraine is really very important. We also have in our panel now two great analysts. This is Vitaly Kravchuk, one of the main authors of the paper which was presented by Gary. Vitaly is a senior research fellow in Institute for Economic Research and Policy Consulting. And we have with us Vitaly Vavrishchuk, head of macroeconomic department of the ICU group. And like previously in his career, Vitaly was working several years at the National Bank, responsible for the banking sector. So I would like to start with some housekeeping issues. Please post your questions to either Gary and as a presenter or our panelists in the chat or in the Q&A session. We will try to answer them during our Q&A. We will have, I think, two rounds of questions and answers, and then I will go to the questions and answers section. As Robert already mentioned, you can download the presentation on the website of the German economic team. And may I ask Slava, or okay, we already have it. The link is in the chat, so you could directly download the report from this link. And then let me please start with Katerina Ryzhkova, Deputy Governor of the National Bank of Ukraine. And the question is actually, my first question to you, Katerina, is our headline question for this presentation. Is the sector's stability enough to keep its role as a backbone of the real economy? Please, the floor is yours.
Thank you so much. First of all, thank you for the good presentation, very interesting view, and for invitation to have opportunity, give me opportunity to talk about it. According to the question, yes, sector has a good shape right now. First of all, because liquidity. Sector has liquidity more than enough, I can tell you. The uninterrupted servicing during the wartime, full-scale wartime, help banks and banking system to avoid any deposit outflows, because the people feel confidence with the banking sector. And of course, the government spending, which ensured by our partners with a normal, unprecedented amount of financial support, government spending fuels liquidity of the banking sector. Liquidity surplus have possibility for banks to place the funds in the different instruments and receive the interest income. The net interest income is the biggest part of the banking profits. And as of today, the profits for 9 months of this year exceeded 100 billion of hryvnias. The profitability helped to keep necessary level of capital adequacy ratio. Today, the capital adequacy ratio is 25%, which is well above the required minimum. And today, we have no bank who violate the capital adequacy ratio. It means from 3 maybe most important sphere, liquidity, capital, and profitability, we see the sector has a good shape. And this year we have started the AQR and stress test. The 20 biggest bank, which hold 90% of the banking assets, are involved in this stress test, and preliminary results shows us that there are no any significant needs or no significant gaps in capital. The banks assessed the credit risk. The banks created all necessary provisions for credit risk, and the level of profitability will allow banks to support their capital needs in future. So it means, from our point of view, the banking sector is well prepared for supporting real economy and recovery of the country.
Many thanks, Katerina. And now my next question would be Mr. Pogosyan, Artur Pogosyan, Deputy Head of Ukraine Financial Institutions at the EBRD, European Bank for Reconstruction and Development. I know that the bank is one of the most active international financial institutions operating in Ukraine, and we are really grateful for all the support you provide. And so given that, what do you see as the key areas of concerns for the banking sector of the country? What can you say about the resilience and about the growth prospects for Ukrainian banks on the more optimistic side?
Thank you, Maria. I hope everyone can hear me well. Ukrainian banks have indeed shown strong resilience so far. They adapted quite well to the situation and continue to offer services to their clients, even if with limited access to branches due to security considerations, obviously, and still operating within the parameters prescribed by the regulator. Most of our partner institutions continue their operations, although at levels lower than before the war, naturally, and managed to replace lost revenue sources with alternative ones. I would say that the main concerns relate to asset quality, that has deteriorated significantly due to the war, as mentioned earlier. However, of course, liquidity levels are still strong and capitalization remains satisfactory, if not to say banks are quite well capitalized. Albeit a bit of pressure is observed, especially at state-owned bank level. State-owned banks comprise over half of sector assets, which is not ideal, and the issue of state dominance in the sector should be addressed over time. Regular asset quality monitoring is crucial, and comprehensive asset quality reviews would be required to assess the full impact of the war on the bank's capital and to define the recapitalization needs and plans. In terms of growth prospects, loan-to-deposit ratio in the Ukrainian banking sector is among the lowest if compared to peer countries. And currently, banks' lending is limited mainly to short-term products to existing clients. That said, we envisage a huge potential demand for longer-term investment loans in the upcoming periods, subject, of course, to addressing the security risks, which currently remain significant, unfortunately.
Yes, this is true, and this is a really sad truth for me. And I now invite Vitaly Kravchuk, Senior Research Fellow for the Institute of Economic Research and Policy Consulting. Vitaly was one of the authors of the report that Gary has presented. So I'm really interested, Vitaly, what are your views on the banking sector stability, major risks and challenges, and the credit growth perspectives?
Well, I agree with previous statements that indeed the banking sector is showed quite a spectacular resilience over the last 18 months or more, thanks to both the cleanup, thanks to the digitalization of the bank sector, the fact that it coincided with transition to card payments, to digital payments, also helped with liquidity. So we kind of a bit got lucky, a bit prepared, and that helped us to remained quite resilient. Of course, as mentioned before, the issue is to increase role of lending in traditional financial intermediation in bank activity, which is a bit lacking this time, of course, for obvious reasons. Not very much tech problems with creditworthy borrowers, problems on the bank side, of course, tremendous size of uncertainty. But we clearly can probably do a bit more now. And of course, we need to prepare for the future. Yeah, that's it for me, I guess.
Thank you. Thank you very much. We do have to be prepared for the future. Now I am inviting to reflect on what has been said and maybe give his views on the major issues, major challenges, and also major strengths of the current banking system situation. Vitaly Vavrishuk, Vitaly, head of the macroeconomic department of the ICU Group.
Thank you, Maria. Thank you for this opportunity to share my views. And I would probably start by repeating what my colleagues, other participants already said. The banking sector has so far exceeded our expectations. I remember March 2022, just a couple of weeks after Russia's full-scale invasion started, and I tried to write my thoughts on paper and keep those thoughts so that I could check in a couple of years whether my predictions were correct or they were wrong. And I should say that in every single aspect, the performance of the banking sector exceeded my expectations that I had 18 months ago. So we have a fully healthy banking sector. We have a banking sector that is properly capitalized, that has huge liquidity. This seems like an obvious fact to us right now, but if we go back and think from a different time point, from March 2022, I couldn't expect that we would be in this position at this point 18 months down the road. And of course, huge credit should be given to the Ukrainian authorities, who did a fantastic job, to the government, to the president, to the NBU, which adopted very timely and tailored regulations to keep the banking sector afloat. But we should also give huge credit to our international partners, which provided huge financial support to our economy, and the banking sector was one of the beneficiaries of that financial support. Huge liquidity of the banking sector is one of the results of these huge inflows of financial assistance. Huge profitability of the banking sector is also one of the consequences of these huge inflows of financial assistance from our international partners. So I think this factor, this huge international financial assistance, can never be, its role can never be overestimated. So I think it was a very good coincidence of many factors which made our sector resilient. Banks were fully prepared for external shocks before the war. The banking sector was clean. Banks had very, very conservative credit risk standards. They had sufficient capital, but also we had very good policy response, and we had very generous support of our international partners. So thanks to all these factors, to the combination of all these factors, we are now in a position to say that we are, I can say we are proud of our banking sector. So Ukraine basically produced a good recipe for other countries which may be facing, well, not wars, but external shocks in the future. So this is a good recipe for many other jurisdictions that Ukraine can share in the future.
Thank you very much, Vitaly. And before I come to more specific questions to all of our panelists, I invite each of you who are the attendees of this meeting to write your questions in the webinar chat or in the Q&A session. I see one hand rising. Unfortunately, we cannot give a floor for the questions, so I really encourage you to write. We will have, I guess, enough time for the Q&A. So please use this opportunity to address one of our speakers and give your questions. Now I want to go to more specific questions, which I hope our esteemed panelists would answer, and I will start with Mr. Pogosyan, the EBRD. What is really interesting about the EBRD's activity? Recently, it announced that it has met the target of deploying 3 billion euro of financing in Ukraine's real economy within 2022 and 23, which is really impressive to counter the impact of Russia's war. Included, there are really extraordinary deals like Ukrzaliznytsia 200 million euro deal for increasing the connectivity with the European Union. This is very interesting. A deal with Mironivsky Hleboprodukt for the 100 million euro bonds refinancing, the Preply equity investment, and others. But what I'm going to ask is, I know that you were involved with numerous deals with Ukrainian banks to provide them with risk sharing instruments, which they can then use to provide credit to Ukrainian borrowers. Could you please tell us more about the instrument itself? Who were the main borrowers for Ukrainian banks? How do you see it working? Do you expect this kind of a security becoming available to Ukrainian companies in future, maybe from the other IFIs, or do you plan to extend the coverage on behalf of the EBRD? Thank you very much. And the floor is yours.
Thank you, Maria. We indeed are really pleased with being able to keep our pledge and deploy 3 billion euros of funding in Ukraine's real sector over the past 2 years. The year is not yet out, and we are still working on a few deals to complete by the end of the year. Hence, hopefully, the 3 billion figure will increase even further in the remaining 2 months of the year. In view of the fact that loan demand from Ukrainian private businesses for working capital and investment loans significantly exceeds local banks' risk-taking capacity, in May 2022, EBRD launched its unfunded portfolio risk-sharing instrument, better known by our partners as Resilience and Livelihood Guarantees, or RLGs. Under this program, our product, we offer A, to increase the partner bank's lending capacity through a partial 50-50 credit risk coverage, and B, to double the amount of new lending partner bank is ready to undertake through this risk-sharing mechanism. Under this product, the partner bank acts as an originator and servicer of the covered portfolio. Under RLGs, we target mainly MSMEs with loan sizes between 50,000 euro and 3 million euros. In terms of targeted economic segments, we focus on food and energy security, vital infrastructure in transport and logistics, businesses supporting livelihoods and strengthening human capital, including for refugees and internally displaced people. Within this instrument, we also offer intermediated investment financing to SMEs, supported with investment grants to address reduced risk appetite and high interest rate environment constraints. The tenor of subloans are up to 2 years for working capital and up to 5 years for investment loans. As for results so far, our guarantees enabled on lending by our partner financial institutions in total amount of close to 700 million euros since May 2022, and we have a very strong near-term pipeline under this product. In terms of utilization of subloans, approximately 64% of subloans in the covered portfolios were for tenors of up to 2 years, and average subloan size within the covered portfolios was around 600,000 euros. Unfunded portfolio risk sharing is so far our most popular instrument deployed in Ukraine, and we envisage continued strong demand for it from Ukrainian banks. Indeed, we see more IFIs entering into this market and expanding their lending under similar instruments. IFIs like EIB, DFC, and IFC are active in this market, and I think more lending under this instrument will be channeled to Ukrainian businesses in the coming periods. We see a potential for EBRD to channel at least 500 million euros of investments annually under our portfolio risk sharing instrument going forward, and hope other IFIs will have similar plans. We, of course, also hope that private investors will return to investing in the Ukrainian banking sector to further increase the resilience of this beautiful country. Thank you.
Thank you very much. Might I ask one follow-up question? As far as I understand, the banks provided with this risk-sharing instrument are able to offer lower interest rate for the loans to their borrowers, or am I not right? Could you please give us the average lending rates at which you see that your bank clients are lending them money?
I will not be able to give you or disclose specific rates that...
Yeah, just the average, the area, where is it?
I can say that as I mentioned, a portion of our funding is provided to our partner financial institutions with grant component. They are specifically addressing, some areas, where we want to encourage lending under certain conditions or under eligibility criteria of our donors, in order to encourage, for example, more competitiveness in the SME sector under our investment loan window. Those grants do help to decrease pricing of the subloans. However, we of course do not prescribe specific level of interest rate to be charged by our PFIs. That's why we also do not necessarily kind of control or know about what rates they offer to the end borrowers. Hope that this at least partially addresses your concern.
Yeah, thank you for this. And I actually have two pretty different questions to our analysts, and let me now start with Vitaly Vavrishuk. I'm just, switching the panelists over and over. So Vitaly, I know that you have made a research and you have done a research on how far Ukraine is from the European Union in terms of the banking supervision regulations. We are soon to see the European Commission document on whether Ukraine will be allowed to open negotiations with the European Union this year. So this is very much interesting, I guess, for all of the sector participants. Which key milestones do you see in front of Ukraine in its way to the European Union?
Well, I would say I've done analysis. This is not a full-fledged research yet, but I will probably publish my thoughts later about how Ukraine's banking sector can move forward to the Ukraine's EU membership. And well, this is definitely going to be a challenge. Ukrainian banking sector has gone through many challenges. We had a banking sector cleanup. We had COVID. We had Russia's full-scale war, and EU accession process is going to be a challenge. This is definitely a pleasant challenge to deal with. But this is going to be a big challenge. It's not an easy milestone that lies ahead of the NBU or the Ukrainian banking sector. The NBU has done a huge progress in terms of implementation banking regulations that are fully aligned with the EU directives. For example, regulations on operational risk, regulations on market risk. There is a draft regulation on regulatory capital structure. There is a regulation on ICAP and ILAP. NBU decided not to introduce any homegrown regulations, which is good, and strictly follow the EU directives and EU regulations. But I would say that so far we have made probably half of the way. There is still a long road ahead, and it's not a 1 year long road or 2 year long road. This is a much longer road. There are many aspects of banking sector regulations and supervisions which are still to be implemented in Ukraine. To name a few, for example, regulation on leverage, regulation on structured finance or securitizations, regulations on counterparty credit risk. There is a very long list of documents which are still to be developed and implemented by the NBU, and we have to understand it's not only about drafting new documents, it's about their proper implementation in practice, so that supervision is also fully based on the EU requirements. Personally, I don't expect that the EU regulations, which are still to be implemented into Ukrainian legislation, will result in significantly higher capital requirements for local banks. I think local banks have enough capital even to meet the toughest capital requirements that new regulations may imply. So this is definitely not going to be a challenge. What is going to be a challenge is that the regulations which are still to be implemented are very, very complex, because they are drafted to describe complex financial products which are still not available in Ukraine, but which will be available to Ukrainian banks if capital markets become open, if there is free flow of capital between Ukraine and the EU. So the NBU and banks still have to learn how to assess those products, and that means they have to make substantial investments into human capital. They need definitely people who are able to analyze complex statistical stuff, complex financial products. So my view that it's the main challenge is not about capital or financial capital. The main challenge is about human capital. We have plenty of time to develop a roadmap and start moving ahead, but we should be very pragmatic and should be very realistic, and not to give false signals that EU membership is just a matter of 1 or 2 or 3 years. This road is going to take much more time, and we should be fully prepared for that.
Thank you very much, Vitaly. This is like there are more than one industries where we do need human capital, and we even discussed that, okay, we might need to develop master's programs from scratch and different trainings in the EU in really different sectors to address the challenges that lie ahead. And before my final question to Katerina Rashkova will be, now I would love to give the floor to Vitaly Kravchuk. And what I know that together with the other colleagues from the Institute, Vitaly is involved into the economic reconstruction monitoring, and he's following the events in the recovery sphere. So my question would be after this panel, and knowing that you are interested in this topic, what could be the banking sector, the local banking sector's role in Ukraine's economic reconstruction and recovery? And do you see honestly the banks fulfilling this role at the moment?
Well, it's a matter of perspective and future, I guess. Well, right now, clearly, it's not enough. There are reasons, but still, it's not enough, of course. In the future, hopefully, we will get there. There is clearly a role. This role will be larger when the security risk and risks and uncertainty will not be as high as they are now. It's difficult to do 5-year loan if you don't know what will happen in 5 years, obviously, in this country with a great amount of certainty. But hopefully when we get to some more degree of certainty for Ukrainian economy, banks will start to feel more of the gap between the self-financed recovery, between recovery that is funded by donors, by the government. And obviously there will be some second round effects. People will hopefully return to Ukraine. They will, some of them will maybe open or reopen or rebuild their business. So there will clearly the more economic opportunity, and banks clearly will have the potential to contribute to helping the Ukrainians and Ukrainian businesses to use this opportunity, hopefully, and I think they will. The question is what kind of help they will need, and what kind of environment is needed to make sure that they are doing the most in filling this gap. Well, there is some obvious answers which we are talking before the war, even. So there is this kind of fundamental issues with loans like security of rights and effective rule of law, fair court system, well-staffed court system. Because if you have the court case which is going to be resolved very fairly, but in 5 years from now, it can also be a problem. So definitely we will need so the fundamentals. I think all the we have a lot of help on that from our donors, because most of the international aid comes with this kind of conditions that should help us to get exactly where I'm in this direction, which I'm talking about. Well, of course, locally, if you're talking more precisely about banking sector, recently we have taken direction, I see, as far as I understand, to move to the markets, internal market status for the Ukrainian financial status, even before the Ukraine accession to the EU. So it may mean a more accelerated schedule for implementing all the EU rules in Ukraine. For banking sector, more accelerated schedule than for some other sectors. Of course, it will depend on EU cooperation. You need significant institutional arrangements to get us to this kind of internal market status from the EU. So you need to have significant buy-in from the other side. And if we have this buy-in, it means that recovery, we will go into recovery mode more or less at the same time as we will implement all this kind of rules. Which means that we need to kind of work on two fronts, make sure that bank finance recovery, and they fulfill all the rules, the newly added rules. I think it's manageable, but of course it will require some careful balancing on the part of the NBU and on the part of banks. So no easy answers aside from very obvious ones, as I mentioned, on the rule of law and etc. So that's kind of my view at the moment. Thanks.
Thank you very much, Vitaly. And now I'm moving to the last question of our panel today. And still encourage all of you who listen, please ask your questions. I see them in the chat, and participants also see them in the chat, and some of them are already even answered. So please go chat Q&A. And my last question will be to Katerina Rashkova. And I just couldn't help myself from asking it, despite our event is now on the banking system. The major recent news on the NBU's monetary policy stance, I guess, is worth discussion, and the impact of these monetary policy changes into the banking sector. So for those of you who do not know, the National Bank has cut the policy rate by 400 basis points to 16% per annum. That was really more than all the market and the consensus expected. But and here is the interesting detail: all the other rates, which means the overnight deposit rates, the lending rates, and 3 months deposit certificate rates, they were left unchanged. So effectively, the monetary policy remains the same, but simultaneously the difference between the major rates and the key rate has changed. So I would like to ask Katerina, what was the reason behind this change, behind this decision, and do you expect actually on the banking sector, and what exactly impact are you expecting?
Yeah, thank you so much. First of all, about the reason, key policy rate should play the most important role in the market, yeah. And if you look at the market rates before this decision, we can see that the most important role was played by the interest rate of the overnight deposit certificates. So it means we made this decision to align our rates with the situation which we have. Again, at the same time, we did not change our rates with the operation with banks. So the last decision will not have directly impact on the banking operations. But of course, because we are talking about the sum forecast, and we shown that we expect that our key rate still have the room for the decreasing in this year. We understand that banks will start to adopt their interest rate policy with our expectation and our forecast. We also, right now, we already see that some interest rates on the deposit side is slowly going down. Yeah, it means the bank is starting to adapt. What will be or how the impact will be in future? I can tell you that the banks have high interest margin. It means so different level, but it's above 5%. You know, it means there are more than enough room for adaptation with new conditions. It should have positive impact on the level of the credit interest rates, despite the security risk will remain very high and unfortunately uncertainty. But again, if you are talking about the cost of funding, we understand that from this point of view, it will have positive impact on the level of the rate of credits. So finally, as let me sum up. Our monetary policy, our goal when we make a decision in the monetary policy area, to avoid any shocks for system. So we have started the cycle of decreasing of the key rate, several committees before, ago, and we communicated it with the sector, with the banks, try to prepare sector for further changes and developments. And I think that our latest decision, first of all, in line with our previous communication, and that's why will not bring any negative impacts on the banking sector, banking profitabilities, and of course will continue to, let me say, to ensure the transmission of our key rate.
Thank you very much, Katerina. And now we still have several minutes. I invite all the speakers in the panel or our esteemed presenter, if anyone wants just to give the latest final reflection or some thesis, or to say something to reflect on something which has been said, you might just raise your hand, and you might have the last minute, and if not, if no one volunteers, I will go to the questions and answers. Okay, so far we have no one, and I'm starting with the Q&A section. Here we have two questions. I believe both of them are addressed to Artur Pogasyan, and I guess that we don't have a second question anymore. What happened to it? Okay, Olena Novarova, could you please, I don't know, either write the question in the chat, or I would be unable to ask it again. So then the first question: what is the place of the responsible business conduct standards for the financial sector in the recovery agenda? I believe that for the responsible business conduct standards, I guess that's mostly a question to you, and maybe Katerina would like to reflect on that as well. So who will be first? Arthur, could you answer this question? What is the place for responsible business conduct?
Arthur just wrote that he had to switch to next call.
Okay. Yeah, unfortunately, we don't have him. But guys, what is good that he answered several questions already in the chat. So you might see Igor Orekhov and who else was it? Peter Koslinski. Two of your questions are answered in the chat. So Katerina, then if you could elaborate on the place of responsible business conduct standards in the financial sector in the recovery agenda, please let us know.
Yeah, I can maybe give some our view because we have started to work on this issue earlier before the full-scale war, and we are working on this together with the World Bank. World Bank helps us to create all necessary requirements for the financial sector according with the European Union principles and approaches. It's not easy, I can tell you, because the main idea of the ECG to provide finance for the companies which are aligned with these principles. That's why my personal opinion, to implement all the standards in Ukraine, we need to start from the economy, not from the banks, because today I am afraid we cannot find a company in Ukraine which will be fully aligned with this principle and regulations. It means if we implement or introduce full requirements for the banks, we will not be able to support economy from the lending side. It means we need to start from the, let me say, from the level of economy. We need to, first of all, we need to match our industries with the standards of the ESG on the government level, and after that create and introduce step by step the requirements for industries, and give them time to adapt their activity, and after that banks can be able to require from the business all these standards be fully implemented and so on. So it's a huge but very it's a huge road, as Vitaly said. It's not easy. It takes a lot of time, but we need to start it right now because we understand that the recovery, which I hope and everybody hope we will start soon after the victory, will require a lot of investments. And from this point of view, very important that this future investment will be companies and businesses which will provide this investment will provide it's according with the standards of the business social and environment responsibility business. So, and of course it's very important for our business if you're talking about our future European future, because a lot of things, possibility for export, for import, pricing also will depend on these standards. So this is my answer. We are working at the NBU side on this, but again, we are working also with the government, trying to set up this process on the high level in the country.
Thank you very much from me and also from the author of the question. And I'm coming to the next one, which I personally just love, and I would also want to know the answer. And this question would be to Vitalis, Vitaly Kraschuk, Vitaly Vavrishuk, and also to Gary Palushkin, because this is the question from Igor Lehov. When would the analysts and bankers recommend the National Bank and the Ministry of Finance to start selling state-owned banks? I guess this is a brilliant question. So please share with us. I don't know who will go first. Gary, Vitaly, Gary. Okay.
I can start, and then both Vitalis. Privatization is one of main issues and aspects to look forward. But now, in this very difficult war situation, it's not on the first agenda, I would say, because the current uncertainty is huge, and we have also now more reforms are needed, for example, in the sphere of corporate governance. And so I don't see that much possibilities for privatization now during the war. But for the future, and also with involvement of IFIs, the EBRD, and other international financial institutions, I think this will play a very important role also with Ukraine going towards EU membership.
Thank you, Vitaly. Each of you, Vitaly Kraschuk, please.
Okay, so yeah, I agree with Gary in general that on the one hand we need to get a fair price because there was quite significant investment in recapitalization of state-owned banks, which ideally would be recovered after privatization, which is quite hard to do when the war is going. On the other hand, of course, I agree that we have quite high share contribution of the state-owned banks to the overall banking system, and I think it would be beneficial if this share would be lower. I think, as far as I know, banks worked quite hard on privatization issues before the war started. I would, of course, urge I think there was some idea of initial IFIs. Some have taken stake in some of the state-owned banks. I think it's a good first step, which can be achieved probably as soon as there is some stability, which can allow for responsible outside investment in the state-owned banks, where you can actually value the banks on the government side and on the investor side. I think it should be done quickly after we can do that. Thanks.
Vitaly Vavrishuk, please, 2 words: when to sell and then explanation.
Well, the decision to privatize state-owned banks has been delayed many times, and for good reasons. There are many legacy problems at the 3 banks that the government owned before the war, but now that Sensbank, former Alpha Bank, became state-owned, I guess we have a first good target. We have a first bank which is fully investable and which can be put up for sale practically anytime when safety situation improves. So I guess the sale of Sensbank will be a test for the authorities' determination to reduce government footprint in the banking sector. So I'm not calling for a sale as soon as possible, but once we have a better clarity on the safety situation, I guess there are no reasons to delay privatization of Sensbank.
Katerina, I'm asking you to reflect on this question.
Yeah, look, I absolutely agree with Vitaly because, you know, the Sensbank bank is less state than other. It's more business oriented and commercial oriented. So it's really can be the first goal or first target for selling. Of course, today it's quite difficult to find the real interest from the investor to invest into the banking sector, particularly because the uncertainty. But I think we need to start to think about it because we have the experience how to work with IFC or EBRD. We have some, let me say, list of requirements which should be fulfilled before the privatization process will start. That's why I think we can, let me say, start preparation work to be able to sell or to privatize at least one of the banks, state-owned banks, as soon as the situation will allow us to do it.
Thank you. And the next question also goes to you. The question comes from Tamara Denisenko, and I see several of them in the chat and one in the Q&A. I guess I will summarize. The question is on the role of credit unions in Ukraine. Could they be beneficial for the credit growth? Could they be beneficial to people, to the economy, to the recovery? And what is the National Bank's position on that as a regulator? I hope Tamara that I summarized what you wanted to ask. So please.
Yeah, if you compare the share of the credit unions with the banking share, it's obviously very small. But it doesn't mean that credit unions' role is, let me say, is less important. Let me say, yeah. Obviously, they play very important role, especially if you're talking about small business units, and we see the experience of other countries where the credit unions is quite, let me say, popular. But what I honestly see right now, first of all, at the 1st of January 2024, the new law of credit unions will be enacted. And right now we are working under a lot of regulations which should be aligned with this new law. And the regulations or the area which which should be the area of regulation which should be changed. It's a capital requirement, risk assessment requirement, and the corporate governance of the credit unions. Corporate governance including internal control and many other things. And of course, a lot of will be depends how the credit union will be able to adapt their existing business model, existing approach with the new requirements. If they will do it, because we will give them not less than 6 months, maybe even more, due to the full-scale war. If they will do it successfully, they will really have new opportunity for development, and of course they will have new opportunity to be beneficial from the recovery period of Ukraine, you know, because for this they need to be well capitalized, they need to be under good management and good governance, they need to be transparent, they need to be able to become a part of the deposit guarantee fund. It means they need to implement the IT system, which should allow them to provide all necessary statements for the fund, for the NBU, and so on. So it means the credit unions could be the beneficial, but they need to do a lot of homework.
Thank you very much. That was, I guess, all-encompassing in the NBU's position. We still have some time. If anyone from the audience has any questions to add to this, please do this now, or we will be wrapping up this discussion. Okay, the last question. I see it in the chat. What is the real asset quality of state-owned banks nowadays, comparing to 2014-2016 situation? What are the main sources of state-owned banks' sustainability during the war instead of high incomes from investment portfolio of government bonds and liquidity increase from budget sector salaries? So as far as I understand, the question is the only source of the state-owned banks' profitability and capital and sustainability, the governmental payments on the investment portfolio and liquidity increase from budget sector salaries, and is asset quality is better or worse? And Katerina, could you take
So I will try to start to answer. First of all, if you're talking about asset quality review results, it's without any doubt, it's much better. In 2014-2015, we recognized the huge capital gap in the state-owned banks. Now we don't see significant needs for capitalization, and we see that the banks can support the capital by the income, by the profit. You know, this is very important for us and for government. The second one, it's because the credit standards was improved dramatically since 2014-2015. And today the risk appetite, the approach of the assessment of the clients, of the business plan of clients is completely different and closed by the EU standards, let me say, yeah. So that's why the general situation is much better. If you're talking about the role of the state-owned banks right now, of course, again, it's everybody understands that today they play the very important role to support government. Yes, they invested and they are investing to the government bonds. We understand that the budget deficit is huge, and unfortunately, despite the unprecedented huge financial assistance from our partners, we cannot cover this budget deficit without the internal market. That's why today, when the unfortunately credit demand distressed because the economy was shrinking, yeah, due to the war, the state-owned banks, first of all, support the budget. But it doesn't mean that they are not providing the lending for business. They do it. They support the they are our critical industries. And from this point of view, help us to support the economy in general. I mean, energy, first of all, and other, because without these industries, unfortunately, we cannot talk about the adaptation of economy, about any developments. So, and of course, they provide financial support and credits to the agriculture, to the SME. They're using government programs. They're using the products which our partners are proposing us, I mean, risk share guarantee and other things. But again, today, the state-owned banks, it's a, let me say, a very important part of the financial sector which support the economy and government.
Thank you very much. And last but not the least, as always, very practical question from Igor Alehov, like super practical. How does the National Bank deal with the policies of the European Union banks, which are now adopting policies towards Ukraine as a high-risk country, and even often refuse to accept payments and remit them in favor of banks in Ukraine? So the financial, yeah.
I think it's something about money laundering, yes?
Financial monitoring or risky area.
Because you know, I can tell you that I don't think that today it's a big problem for our banking sector. It was the problem in 2014, 2015, before we had started to introduce the new anti-money laundering rules, amendment law, and so on. Today, I don't see the huge, or maybe I cannot tell you that it's some dramatic problem, because of course the EU, not even EU, banks from other countries before to start some operation with Ukrainian banks should make some due diligence. Understand first of all which procedure are used by the bank to avoid or to prevent any possibility to use the banking infrastructure for illegal targets or something like this. And I can tell you that the most of our banks, at least the biggest part of banking sector today, fully implemented all these standards, developed their internal operational system, which can give them possibility to analyze the client, analyze the transaction, to match, I don't know, all necessary things between each other. And I don't see the problem. Maybe I cannot understand, I cannot catch the question, but from this point of view, I don't see, and I not even don't see, I don't expect the huge problem in future in this particular area, because we are improving the AML standards every year, trying to be close to the best European and world practices. From this point of view, we are working with our colleagues from IMF. We are receiving a lot of technical assistance from the other financial institutions, which help us to, let me say, improve our legislation and our regulations. And after that, to check how the bank implemented. So this is the answer.
Mm-hmm. Thank you very much. I guess we are out of the questions for the moment. And I want to thank all of our esteemed panelists for their kindly shared thoughts and insights and a really interesting discussion. Robert, would you like to say some closing words, or I should wrap up?
Yeah, from my side, it was really an interesting presentation by my colleague. I think it was a good report. It's a good report. And then also the discussion was very interesting. I think many new insights also from the questions and the way you address the questions. And last but not least, also thanks a lot, Masha, for your moderation. Thank you.
Yeah, so just one final remark. The recording of this event is available on Center for Economic Strategy Facebook as usual, and we will be glad to see you in all our other events. And at the end of each event, I'm asking everyone who is participating to donate to a good cause, Tactical Medicine, Saving Lives, the Leka Foundation in Ukraine. You can find all the details on their website or Center for Economic Strategy website. Thank you very much all for being with us here today.
Thank you.
Thank you. Thank you.
Bye.
Bye.
Thank you.